Hello, Ben Kingsley here, CEO and founder of Empower Wealth, and I'm here with Michael Savy, the head of our financial planning division, and we're going to be talking about the 2015 share market and equities outlook. But before we do, let's recap 2014, Michael. How did you see the second half of the year pan out?
The second half of the year was a little bit more difficult than the first half. We started the year well, but the second half we saw the commodity prices come off quite significantly, with the hard commodities being copper, iron ore and those areas. And then in the latter half of that, the last couple of months, which we've all would have experienced, the oil price has come off quite a bit.
Yep. So, I mean, we saw a little mini rally just before Christmas. How do you, was there any read into that in terms of probably a bit more optimism than pessimism?
Look, I think the mini rally there was a slight correction from the oversold capacity in late November. We had a drop in October and then subsequently in November, and that's run back up to where it was. But as we lead into this new calendar year, it's certainly a little bit more volatile, and we're seeing that with the 200-300 point moves in the US market, which obviously flows through into the Australian market.
Okay, so let's dig a little bit deeper around oil and also those hard minerals, so those hard mining assets. So talk to me a little bit about oil. What's your read around the oil market, and why is it doing what it's doing?
Look, at the moment, the production, there is certainly a little bit of oversupply in the market. I think somewhere to the tune of around about 2 million barrels a day at the moment. Part of that problem is because of the amount of production that the US, through the shale oil production, is adding to the pot. On the flip side, or on the other side of the equation, we have the demand side. Globally, we're expecting, or we've been forecasting, that demand is going to be a little bit softer, partly through China and Europe. So when we play those two factors out, there is a suggestion that oil prices should be going down. But should it be dropping to the 40 or 50% that we've sort of seen? That's a different question.
So OPEC, which is obviously the major conglomerate that produces the majority of the oil for the globe, what do you think their decision is to keep oil production at current levels? I mean, what's behind that?
Look, there's a few theories around that, and in part, one of the more popular ones is obviously around the US production. The US contributes around about $9 billion or $10 billion at the moment per day. In
dollars or barrels?
Sorry, barrels.
Yep, barrels, yeah, great.
10 million barrels per day. OPEC generally produces around about 30 million, of which Saudi Arabia adds about 10.
The vast majority of that,
The US is actually producing on par at the same rate as the Saudis.
So basically the US has become a net exporter of oil as opposed to an importer of oil because of this shale gas and these new technologies that are allowed that. But obviously it's a little bit more expensive to get out of the ground, isn't it?
That's right.
So is that why we're seeing OPEC sort of making a call to sort of say, okay, well, if we price oil at a certain point, there might be some producers who can't sustain their operation, and then we can potentially look at seeing the price move.
That theory is very much based on a geopolitical or strategic move by the Saudis in terms of, at the moment, they're probably looking to shore up their market share. Pre-GFC, when shale production or US production was probably 5 million barrels per day, they could drop their production rates down a little bit. But at this stage, which they did, they dropped their production rate so that the surplus went to around about, I think it was 4 million barrels. So they had that capacity to do so. But now when the US is theoretically their largest competitor, they cut back their production, then they'll lose market share to the US.
Look, and if we impact, I mean, oil basically is such a major commodity, you know, other than money, it's the biggest commodity on the planet. So when we see prices down, you know, sub $50 a barrel, that's obviously going to have flow-on effects to manufacturing and to industry, and obviously at the bowser, like you said earlier. So the question then is, that's actually a good thing for the global economy, isn't it? I mean, it just makes inflation, that sort of falls away because of the amount of stuff that we produce from oil is incredible, isn't it?
That's right, and the oil is a key input into production and also for consumption for a lot of the OECD countries. So that's the big picture item here, in that lower oil prices will certainly impact certain economies harder than others, but it will also benefit a lot of the OECDs and developed markets. The IMF recently just came out and said that they estimate that the reduction in oil price will probably add 0.3 to 0.7 to global GDP.
That's fantastic.
And domestically in Australia here, if we think that we're a large consumer, the price drop so far has actually added, the price drop at the moment that we're feeling is the equivalent for a standard, if you had a $300,000 home loan, that's a 0.3% interest rate reduction.
Okay,
that's what it equates to.
0.3, so 30 basis points.
30 basis points.
Effectively, that's interesting. So, and obviously, so from roughly $1.50 a barrel, $1.50 a litre, down to around just above $1.
That's right. So for most, the average household, generally, when you go to the pumps, you'll probably put in 40 litres into the tank, which would probably be about $55, $60. Now we're paying, so we're saving ourselves probably $20 a week on that. So
fantastic. So that's disposable income coming into the household, hopefully getting spent and impacting GDP. So that's great. So from an oil point of view, it's actually potentially a blessing in disguise, and it could stimulate some global growth and some global activity. Let's talk about hard minerals and hard resources.